talk about portfolio investment decisions. In this full video, we would be talking about theory, anomalies, and market efficiencies. Let's see what we will cover throughout the video. We will give a guided tour through portfolio theory and its real-world cracks. First of all, we would be learning about CAPM. I will see both the theory and empirical reality. At the same time, we will talk about factor models. Specifically, we will be learning about Fama, French, and Carhart extensions. Apart from these, there are some sort of anomalies which we can see in the real world. We will talk about momentum, size, and value premiums. Moreover, we have to check the efficiency and factors like EMH, FMH, and informational asymmetry. Well, first thing first, what is CAPM? Let's see how the theory can be described and at the same time what is the reality. The theory denotes that expected return rises linearly with systematic risk. Here we can see the equation. It shows as mean variance optimization, homogeneous expectations, and frictionless markets. Also, we see there the risk-free borrowing mechanism. What we see in the real world, we see the security market line is flatter than predicted. What does it mean? It means low beta shocks and low beta stocks and high beta stocks. Low beta stocks earn higher alpha than the model predicts, and the high beta stocks systematically underperform CAPM forecasts. And the null alpha or the alpha equals 0 is rejected in longitudinal data. Beta alone cannot explain returns. Well, let's see the movement between 1 factor to 4 and how asset pricing models evolved to explain real returns. In the CAPM market model, we see that market is the key factor or driver. In the case of Fama French model, we see three factors like market, size, and value. In the Carhart model, which was innovated in 1997, there are four factors ranging from market, size, value, and momentum. Let's know what momentum is. Actually, momentum is riding the trend, and as we know, past winners keep winning and past losers keep losing. Just think about a cricket match. Whenever a momentum is for a particular team or a particular player, he has been dominating throughout the match and he will be dominating in that particular match. And once the momentum is shifted to the other player, and he or she is likely to dominate in that phase of that game. So in the financial market, we see that the strategy works in three steps. Firstly, we can rank the stocks by past 6 to 12-month returns. We can form portfolio, and in the third phase, we can hold and maintain the position to 3 to 12 months. You can see the equations here. What is the R of momentum, which is RW minus RL. If markets were efficient, uh, ER of momentum would be zero, but empirically we see that it's larger than zero, which denotes a persistent abnormal return. Whenever it comes to the size and value premiums, we see that size premium can be described from R small deducting the R big. It might exist due to higher bankruptcy and distress risk, lower liquidity, and higher transaction costs. Also, less analyst coverage and information. The value premium, um, the value puzzle, it can also be called as mispricing. We can see the risk view as distress, cyclicality, and inflexibility. The behavioral view, investors over extrapolate growth, prices revert, which in turn v- outperform the value stocks. But their equation or a critical question, I would say, arise that how do prices actually move? Okay, well, we can see the three nested models of market dynamics. One is random walk, uh, which shows strict independence. You can see the equation here. Also, there might be martingale, um, which is conditional efficiency, which shows conditional efficiency, and the mean value here is unpredictable. But volatility can cluster a weaker, more realistic assumption. In the case of random work, returns are IID, variance grows linearly with time, and we don't see or don't find any structure at all in the past prices. In the case of EMH, we see informational efficiency and prices fully reflect the available information. Mm. However, we can see weak or semi-strong or strong forms that might differ in information set. What is fractal markets? If we see it in from a different lens, the highest exponent for the case of random walk is zero point 0.5. It's persistent whenever it's more than zero point 0.5, and the age value, whenever the age value is less than zero point 0.5, it shows the anti-persistence and mean reverting behavior. In the case of persistent behavior, we can um, describe it as a trending market or momentum likely market. What FMH actually adds, it adds power, low return distribution, and long memory in the market. Liquidity also rises from heterogeneity. That concludes that markets aren't merely efficient or random, they are complex and multi-scale. When it comes to efficiency paradox, why perfectly efficient markets cannot exist? We can explain the question or the paradox with Milgram-Storky theorem or Grossman-Stiglitz theorem, which was described in 1980s. It talks about the information paradox, which means if prices reflected all information, no one would pay to gather it. But if no one researches, prices cannot be informative. That means perfect efficiency is impossible according to the Grossman theory, and according to the Milgram theory, no trade-off. The no trade theorem, which is also called, that says that if everyone is rational and information leaks through prices, no one should trade. That means the buyer's interest signal undervaluation, so the seller refuses and at that time trade unravels. Yet market trade billions daily, so the conundrum or paradox remains. In equilibrium, markets are efficient up to the cost of information, so informed traders aren't just enough to cover their research. Uh, at last, to conclude, if we bring the chapter together, uh, what are our key takeaways? We, we can conclude that the beta isn't enough. CAPM is a starting point. Size, value, and momentum factors capture systematic patterns that CAPM misses. And throughout the study, we've seen that anomalies are always persistent. So, momentum, small cap, and value premium survive across markets. The rational versus behavioral debate should continue or will be continued. And we have seen plenty of times that efficiency has limits. So random walk, whether you talk about random walk, martingale, or EMH, from a hierarchy, but information costs and noise traders make perfect efficiency impossible, which is pretty common in the financial markets. And that's all from me. I'm Sir Tahmid Alam. My registration number is 2023 22 10 26, and I'm currently pursuing a master's by coursework in economics from Shah Jalal University of Science and Technology. If you like my video, please don't forget to subscribe and comment below.